So the housing market, like pretty much everything over the last couple of years, has completely spiraled out of control. After years of direct government stimulus, repurchase agreements, and delays on things like rent and student loans, we're finally coming to an end, and it's not looking great. With the average rate on a 30-year fixed-rate mortgage on the rise again, people can't help but wonder if they're doing the right thing by trying to buy a home right now. People are starting to wonder if they should just be holding out and try to get some cheaper prices maybe 6 months to a year from now. But if you play that game, it's hard to know when home prices are finally going to be coming back down. Most people would think that with interest rates finally coming back up again, home prices have to adjust downward to meet the demand. But currently, the median home sales price has more than doubled since the bottom in 2009, and it's not showing any signs of slowing down just yet. Seriously, if the prices of homes were going up while rates were cut to nearly zero, why are home prices still going up now that interest rates are reversing and finally coming back up? We're going to get into all of that here in this video, but do me a quick favor while you're here and click the like and subscribe button. It really means a lot, and let's get started. While doing some research for this video, I found a working paper by the Bank for International Settlements written by these names right here. I'm not going to try to pronounce them, and they observed the exact phenomenon that I was just describing. In the paper, they say, "We find that real house prices display inertia when they adjust to new levels, and that changes in short-term interest rates from up to 5 years in the past can have a significant impact on current changes in housing prices." So right off the bat, we get some information that makes us believe that we won't fully feel the effects of today's interest rate changes until Elon Musk is sitting on his beachfront property on Mars. They go on to give their explanation by saying, "We interpret this as a consequence of the large transaction costs associated with trading residential real estate, which implies that the demand for housing adjusts slowly in response to changes in interest rates and other driving variables. Given this protracted response, modest cuts in policy rates are unlikely to rapidly fuel house price bubbles." They go on to say that U.S. house prices tend to move in the same direction for about a year after being hit by a disturbance, and then exhibit a modest reversal. My interpretation of this is that since the 2008 and 2009 housing bubble, the 30-year fixed-rate mortgage has been on a steady decline, meaning that we could have been building up this bubble for more than a decade, and the rate hikes that we're feeling now might not be felt in full for quite some time, just like all the damage you're doing to yourself by not making it to the gym every morning. After all, the median home sales price didn't start coming back up after the 2008 crisis until about 2012, 4 whole years. The information that I've read in the BIS paper might suggest that our tendency to increase rates by 25 or 50 basis points at a time might not rapidly affect the housing market, but rather it may set the stage for a gradual slowing of price increases and then a slow, gradual reversal. If the Fed continues to hike rates for a prolonged period of time, and with the completion of the tapering off of stimulus, the housing market could be set up for a multi-year downturn in which prices come back down to fair market values that might have been considered normal had we never entered into such a heavily stimulated economy. In simplistic terms, with the Fed propping up asset prices by pumping trillions of dollars into the economy, they might have very well just kicked the can 3 to 5 years down the road, and in doing so made it much worse for all of us in the future. As the rates come back up, whether it's 0.25% per month or 0.5% per month, I think we see the housing inventory slowly creep back up to stable levels, and once that happens, the house prices can come back down once the supply catches up to the demand. Further suggesting that home prices have to eventually come back down to earth is the nature of the lending process and how higher interest rates affect home prices. When someone applies for a mortgage, they have to qualify based on a variety of different factors. One of those factors is their debt-to-income ratio. This is a percentage that compares your outstanding monthly debt payments to your monthly income. Lenders like to see this below a certain percentage, usually saying that no more than 28% of your total monthly income can go towards your mortgage, and that no more than 36% of your total monthly income can go towards debt payments in general. So public math would tell us that if you're making $5,000 a month, no more than $1,400 per month should go towards your mortgage, and no more than $1,800 per month can go to debt payments. Now, how does this relate back to interest rates and home prices? Well, as the 30-year rate comes back up, new mortgages are going to have higher monthly payments for the same loan amounts. For example, if you bought a house for $500,000 in 2021 and let's say your 30-year fixed rate mortgage was 3%, your payment would have been about $1,686, not including taxes, insurance, etc. If you bought the same house for the same price now, and let's say your new 30-year fixed rate mortgage is 5.5%, your payment would be about $2,271. Circling back to the debt to income ratio, in situation 1 with a 3% interest rate, your monthly income needed to be at least $6,021, assuming that you had no other debt. In situation 2 with a 5.5% interest rate, you need to have at least $8,110 of monthly income in order to qualify for that loan, assuming you had no other debt. That means you need to make about 35% more money every month in order to qualify for the same home loan at 5.5% as you would have at 3%. This would mean that people right on the cusp of that maximum debt to income ratio would either have to buy a cheaper priced home or put more money down to lower their monthly mortgage payment. Let's say that somebody wants to go the route of putting more money down in order to lower their monthly mortgage payment so that they can still get the home that they want. Maybe they found the home of their dreams and somehow it was priced at $500,000 in 2021 when interest rates were at 3%, and it's still on the market at $500,000 now whenever interest rates are 5.5%. Instead of putting 20% down or $100,000 on a $500,000 house, they would now have to put $203,000 down on a $500,000 house, more than doubling their down payment. Doing this would give them the same monthly mortgage payment that they could have gotten on a $400,000 loan at 3%, now for a $297,000 loan at 5.5%. This could price a lot of buyers out of the market they were previously looking in, which could speed up the buildup of the higher priced inventory. With less buyers in the market, prices eventually come down to force equilibrium between the supply and demand. I've personally been wondering if our current situation could be compared to the US subprime mortgage boom of the 2000s, in which there was a ton of stimulus in various forms and rates practically at 0%, which in the 2000s made many people overreach and purchase more home than they could afford. This led to a massive amount of foreclosures, and I've been wondering if that's going to happen again. It'll be interesting to see how this plays out over the next few years. Those are just my thoughts on the current state of the housing market. I'd be interested to hear yours, so if you don't mind sharing, leave a comment down below and let me know your thoughts. I appreciate you guys tuning into the video. Don't forget to like, share, and subscribe, and I will see you guys in the next one.